Visa reports their latest quarter next week, but in the news today because Visa is hiking their quarterly dividend nearly 20%, which sounds great until you look at the actual number and it's going from 21 cents a share to 25 cents a share. Hey, look, it's a boost. I'm sure the Visa shareholders are happy about that. Does this tell you anything about what we should expect next week? Just because I look at Visa, look, it's a monster business. It's a $330 billion company. They've got the cash to hike their dividend, but I don't know. In a weird way, this move raises more questions than answers for me, because I look at this and I think, well, wait a minute. Why aren't you hiking it more? What else could you be doing with that money? What, if anything, does this tell you?
No, I mean, I think you hit the nail on the head there. It actually makes you start asking a few more questions and digging in a little bit deeper. And once you dig in a little bit deeper, I think you come away from that thinking, what the hell? Why aren't these guys paying me a bigger dividend or something? I mean, and there's some pretty interesting numbers behind here. I mean, I'm always happy to see the dividends of the shares that I own go up. Okay, and I'm a Visa shareholder. I never am going to turn that down. But with that said, I think Visa, and I'm not going to just pick on them because MasterCard is essentially the same here. I mean, they're kind of in the same boat. I don't think they're doing enough on the dividend side. And the numbers really do bear that out, particularly when you consider the models generate these net margins regularly of 40% and higher. They just generate buckets of cash. They have strong balance sheets, very reliable competitive positions there. So when you look at the numbers alone from 2013 through 2017, Visa spent $26.7 billion on share repurchases. And that share count's come down, so that's good, right? That helps kind of juice that earnings per share number because it brings down that share count. And these companies are always going to be really valued on that EPS multiple. So $26.7 billion in share repurchases. Over that same stretch, they spent just under $6 billion on dividends. So considerably more of their capital is going to repurchase as opposed to dividends. And I don't know that you would ever really argue one of these businesses to be cheap. I mean, these are leaders in their space. And much like companies like Home Depot or McCormick, you rarely see them on sale. And so then you start asking yourself, well, really, what would you rather have? Would you rather have them bringing that share count down or give me the cash in the pocket? I mean, I think I'd rather give me both, right? But perhaps you could juice the dividend a little bit more because those yields are still only like 0.5%. So, I mean, the flip side of that is, as a shareholder, I think we get to look forward to many dividend raises to come in the future. I plan on holding these shares indefinitely. But as you said, it creates a lot of questions and you come away scratching your head.
Well, and also when we've seen the innovation with companies like PayPal and Square, one of my questions when I was looking over their financials this morning was, why aren't they taking a run at one of those companies? Maybe not PayPal. And I'm not saying necessarily why aren't they going out, sitting down with Jack Dorsey and saying, okay, Jack, we're 11 times the size of Square. We'd like to bring you in-house. How do we make this happen? I'm not saying that, but when I see nothing but share buybacks and dividend hikes, meager as they are, I sort of ding companies a little bit. Maybe that's unfair, but I just sort of look at that and go, okay, those are your two best ideas when it comes to capital allocation.
Yeah, I mean, I think that probably is pretty fair. I mean, Matt Franklin, I've talked about this on Industry Focus before, where we look at companies like Visa and MasterCard, compare them to PayPal and Square. And the neat thing about businesses like PayPal and Square, remember PayPal has Venmo, it has Zoom, so it has a number of brands under that umbrella. These are businesses that were very much built based on mobile technology and technology of today, whereas Visa and MasterCard have been around for a long time, essentially just operate that toll booth. And so I think that those two bigger businesses have suffered a little bit from this move towards technology. And so they've had to figure out ways to partner up with companies like PayPal and Square and find a new position in that value chain, so to speak, so that you can fund your PayPal account with your Visa card that's linked to your checking account or whatever it may be. So Visa and MasterCard still get to play in that sandbox, but they do maintain perhaps a little bit of a diminished role from before. And PayPal is such a big company now. I mean, it's around $100 billion market cap. I think technically still bigger than American Express even today. Square, I think, is headed down that same path. So for Visa and or MasterCard to talk about an acquisition is going to cost an arm and a leg. Plus, I don't think those businesses are interested. And you probably have some antitrust questions as well. But I think they're going to continue to figure out ways to partner up with businesses like those to maintain a position in that value chain so they get something, because something is ultimately better than nothing.